Hi, everyone. It's David Edgar. Welcome to Talking Deals with David. I'm going to see who we have on. I think I'm going to give a couple minutes, but we should be live. And this time, for those who followed me on the first session that I did, where we kind of kicked off the Knowing Something series and talked a little bit about what we're doing in some of the M&A discussions that we're having. This one, I was able to rope in two of my partners. Mitch, you're joining us from Chicago, I believe, and Stacy, you're in DC. Hi, Stacy and Mitch. Stacy is going to be talking with us about a topic near and dear to my heart and other people who do inbound cross-border deals. It's a little bit of CFIUS as well as some import-export and trade. And Mitch, of course, will be talking to us about some international tax structuring ideas that you may want to think about if you're doing a U.S. inbound deal. But as the announcements, and I think some of the posts that I made leading up to it, we're going to be talking today about cross-border deals. And I was thinking about it this morning in terms of maybe defining a little bit or ring fencing a bit what is a cross-border deal and what are we going to be talking about today. I'm going to define it fairly narrowly. Although if people watching have questions on other parts of a cross-border deal, feel free to lob those in and we'll try to address them. But what I'm thinking about for today is a non-US company interested in coming into the U.S. By way of an acquisition. Now, of course, it could also be a non-U.S. Party that's selling U.S. assets. But I think just to frame the discussion and to give us a perspective, my thinking is that we'll approach this from the view of a non-U.S. company that maybe you're doing your first acquisition in the U.S. And so you're thinking, what are the 4 or 5 key things that I need to be thinking about as I'm planning to jump into the U.S. market? And so immediately jumped out at me, well, a key component of that are these CFIUS, which are sort of national security review, foreign investment type regulatory process. And then, of course, the tax planning goes along with that. And before I turn it over to Stacy and Mitch to talk a bit about their respective areas, I just wanted to spend a minute and put, I guess, where we are now in Q4 of 2022 in some kind of perspective. I've written a lot about perspective, and for me, these last couple of years gave us plenty of opportunity to really think about what that means. We all came off of 2021, just an incredible deal market that I, at least in my 20 plus years of doing M&A, don't remember that flood of deals, the complexity of deals, just the sheer volume of deals, the size of deals, both individually when you look at the aggregate, and inbound cross-border deals were a huge part of that. Most of the work that I do last 3 or 4 years in particular are these cross-border deals. And I think one of the reasons is I do like complex deals. I like interesting transactions, and cross-border deals give us plenty of opportunity to sort of delve into all kinds of areas of deal making. But I think the other reason is a firm like ours, K&L Gates, is super well positioned to do those kind of deals because they really do touch on all kinds of different areas of laws and different geographies. And you need to bring in a team that has that expertise and talent, and we have that. So it's been a natural kind of growth in my practice, and I think people that have commented and followed my posts, a lot of them have messaged me and said similar things. They are interested in doing cross-border deals, and so that's why I thought it would make a good topic for us to touch on today. But really, almost any deal these days is cross-border. So if you think of it broadly, even a truly U.S. to U.S. domestic deal will often bring in cross-border implications because you're going to have customers, suppliers, offices all around the globe these days. So a lot of these topics, even if you're doing a U.S. deal, are going to be interesting, and we're going to try to make it interesting and hopefully relevant and actionable, so that you come away with this with an idea that not only are cross-border deals happening, people are still making investments in the U.S., but that they're fun and interesting and they're doable. And we're going to try to give you some tips and ideas that hopefully will help you to do that. As I mentioned, 2021, incredible, off the charts on almost all scores. And for cross-border deals coming into the U.S., it was a record year. Every single quarter seemed to get busier, bigger, more deals announced. As we moved into 2022, I think some of that, of course, slowed, and we know all the reasons why, and I posted on it, so I won't dwell on them. But you can see, sort of at a high level, that you have a lot of uncertainty in a variety of markets. Economic uncertainty, interest rates rising, which leads to higher cost of debt, makes financing more difficult in deals. But you also have inflationary pressures. You have a general feeling that economies are slowing down. I think perhaps a bit more in Europe, and maybe people who are dialing in can offer some comments there. Um, but yeah, I think all of these factors are creating a feeling of unease or uncertainty. Um, and I wrote on one of my posts that deals happen in every kind of environment. So if it's a high interest rate environment, a low interest rate environment, um, high economic growth, low economic growth, you can get deals done. The problem is during those transitional periods where you have a feeling of uncertainty. You're not sure, is market's going to improve? Are valuations going to come down? Um, are there going to be additional political or regulatory hurdles that come with a new administration, like we had in the United States a couple of years ago? All of these things kind of were brewing, and I think led to what we're seeing now, which is essentially an across the board slowdown in deal volume, size of deals, numbers of deals announced. Um, you can see that, and it affects, of course, inbound cross-border activity into the United States as well. But what's interesting is, if you go back to sort of pre-pandemic levels, so 18, 19, 2017, we're still at or above in deal activity and deal volume and cross-border activity in the United States. So I would say this period is probably more of just a resettling or renormalizing back to what was a very healthy deal environment pre-pandemic. So we're not in a disastrous deal environment right now. I think we're just in a transitional period, and that period may worsen a bit as we close out this year and then work into Q1 of 2023. But what I'm thinking and what I'm suggesting to clients of mine that are interested in the U.S., yeah, there are headwinds. And I think one of them is also the dollar movement. The strengthening of the dollar is making it, I think, more difficult, more challenging for non-U.S. parties to do deals in dollars. And so there's some opportunities there to think about hedging, pre-positioning currencies. Perhaps a lot of multinational global corporations already have considerable U.S. currency dollars available for acquisitions. Makes it a bit easier. But I think that we're starting to see some stabilization in some of those factors that affect the macro environment. And so as the macro environment stabilizes or hopefully improves, I think we will see more deal activity as 2023 starts to unfold. But if you're thinking about coming into the United States, I think for me, where I've seen deals kind of go sideways is a lack of preparation, um, and thinking about some of the issues that can really make it challenging when you're entering the U.S. markets. And one of the areas that I see a lot of those challenges is in the regulatory area. Um, there are national security reviews and other sorts of regulatory um, approaches and timing considerations that you have to think about when you're coming into the U.S. And Stacy is going to talk a bit about CFIUS and import export and some of the other areas that you'll want to focus on. And then I'll loop in Mitch, and then we'll talk a little about how this all comes together when you're thinking about doing deals in the U.S. So Stacy, I'll turn it over to you to regale us about CFIUS and import export and customs and all those other interesting things that you spend your days thinking about.
Great. Thanks, David. I am very happy to be here. As David mentioned, I'm going to talk about trade and investment issues that perhaps you should consider in any cross-border deal. The sort of two buckets, I would say. First is just on the inbound investment side, and as David mentioned, CFIUS. This is a process where the government may scrutinize and intervene in a transaction involving foreign individuals and entities. And the consideration there is not just the country of origin of the foreign company itself, but also who that company's investors are. There's also considerations about what sector or industry that you're investing in, and the type of transaction. Is it real estate? Is it a U.S. business? What are the notification requirements? Is the target company a government contractor? So I'm gonna hop into some of those details in a second. The other issues I want to talk about are actually sort of the focus is on the target company itself. Are they an importer or exporter? Are there sort of potentially hidden obligations or liabilities that you need to unearth and think about and address? So let's jump into the inbound investment side. And CFIUS, which I'm sure as many of you know, is short for the Committee on Foreign Investment in the United States. So this is, it's a committee, but it's run out of the U.S. Treasury Department. The staff is at Treasury, and they conduct these CFIUS reviews with input from other agencies that are part of the CFIUS team. One thing to note is that the reviews are confidential. So unlike a number of other regulatory proceedings in the United States, there's no public docket. No one is privy to the details of your deal, unless, of course, the companies that are participating in the CFIUS review wish to reveal them themselves. So often these things, there's not a lot of discussion about them, and they're not made public. So we just learn from the fact that we represent companies and our previous experience and work. So CFIUS is looking at potential national security issues and effects of any transaction. Could the transaction result in foreign control of a U.S. business? CFIUS has jurisdiction over certain non-controlling transactions and also real estate transactions. So it kind of covers the gamut here. The purpose or the sort of benefit of a CFIUS review, and I'll talk about that in a second, is that when CFIUS completes its actions with respect to the transaction, and assuming they give it the green light, there's no national security implications, or if there were, we've figured out a way to mitigate those concerns, then the parties receive a safe harbor with respect to that transaction. So the safe harbor would limit CFIUS from subsequently initiating a review with respect to that transaction. And the reason this is important is that at any given time, for transactions that have not gone through CFIUS review, if CFIUS decided that 3 years down the road or at any time in the future, if there is a national security implication from that deal, they can review that deal and they can, if need be, unwind it. So, you may cut a deal, buy a company or invest in a company, and years later, CFIUS could unwind that deal. Recently, President Biden issued an executive order that was highlighting 5 factors of particular sensitivity. I think it's important to mention these. It sort of gives you an idea of what this administration is focused on, where there are particular sensitivities related to U.S. national security. Some of them are a bit ambiguous, but let me quickly run through so you can sort of, file this away in terms of your target investments. things that might impact, or an investment that might impact U.S. supply chains, the impact on U.S. technological leadership. And the executive order identified a few technologies of particular interest. Those are artificial intelligence, quantum, biotech, and advanced clean energy. The other thing, one of the other things in that executive order is that CFIUS needs to consider foreign investment trends, not individual isolated transactions. So let's say your target investment involves laser technology. CFIUS might consider, that sort of one-off transaction targeting a laser technology company, doesn't raise national security implications. But if there's a trend, if there were 3 other recent targeted investments in laser technology companies over the past, say, year, that might raise some red flags. The other issues mentioned in the executive order, cybersecurity risks, and then risks to U.S. persons' sensitive personal data. Transactions that CFIUS can review, they include mergers, acquisitions, joint ventures, leases, and other investments. CFIUS is looking at whether or not the transaction results in or provides control, either directly or indirectly. So when the foreign investor invests in a company or buys a company, do they have control? Can they decide important matters affecting that U.S. business? CFIUS also looks at non-controlling investments. This is particularly important in what we call the TID businesses. So these are businesses that operate in, the T stands for technology, critical technology, the I stands for infrastructure. So critical infrastructure, and the D stands for data, sensitive personal data. So even if the investment does not result in control, it still might be subject to CFIUS review. And the third bucket would be real estate transactions. The real estate transactions, usually the concern is about specific types of sites, for example, ports, in particular airports, maritime ports, and then military installations as well. So is your real estate purchase located in close proximity to ports or to certain military installations? So that can also trigger CFIUS review. There is also a white list of accepted foreign states. So these are countries whose investors may sort of get a jurisdictional carve out. They may not have to go through a CFIUS review. At the moment, the white list includes New Zealand, Australia, Canada, and the UK. So what's the process? Just an abbreviated sort of description. There's sort of 2 types of processes. The first is what we call a declaration. So this is kind of CFIUS review light, if you'd have it. It provides for a 30-day, there's a 30-day assessment period. It is mostly voluntary. And this could be a situation where, you're pretty certain that your intended target company and your purchase of that company, your investment in that company are not going to implicate any national security considerations. However, it would be nice if you can get CFIUS to confirm that, and you could get your safe harbor sort of confirmation. So this declaration, again, this is not as much data is required, and it moves at a quicker pace. There are, however, certain situations where a declaration is mandatory. This involves where a foreign government is acquiring a substantial interest in U.S. business. It also could be mandatory if the transaction involves critical technologies. So again, this is still the shorter review by CFIUS, mostly voluntary, and you do get a safe harbor letter if you pass muster. There may be situations where you file a declaration and customs doesn't want to give you a safe harbor letter. They leave it ambiguous in a sense. Or you just go straight to the full CFIUS review because you're pretty sure that your transaction implicates some concerns or could raise some concerns. So a full CFIUS review is much more detailed. A lot more data is collected. there's a 45-day review period, a 45-day investigation period. There's even an option for sort of a pre-review by CFIUS staff. In this process, it is possible that in the course of the review, CFIUS says, there are certain aspects of your transaction or things about the company that's being acquired that present national security risks, but we think we can work to mitigate those risks. And so you could craft an agreement with CFIUS to mitigate risks, and CFIUS could then, under those circumstances, move forward with the safe harbor. So again, the process can be quite detailed and very thorough, and really looks at who the investors are, not just sort of the company that's engaging in the transaction, but who's behind that company, who the investors are. So a very detailed process, but definitely something to be aware of.
Stacey, if I could jump in for a second, it's very interesting, and I think one thing I wanted to mention that what I've seen on deals, and I think the way to approach it is, again, it's a competitive environment. So even though we're seeing some slowdowns, as I described, valuations are still, kind of sticky. I guess I've been describing it as, coming down for target companies, especially in some of these areas that Stacey mentioned are sort of a focus. So in tech or AI, these are companies that are still very much in demand as companies look to build out sort of inorganically in some of these areas. And so you're seeing still a competitive environment for a lot of U.S. based assets, and that translates into another point that this kind of brings up to me, is that a lot of the terms also have stayed relatively seller favorable. I mean, we're coming off 3, 4, 5 years at least of kind of a general trending toward much more seller favorable terms in deals. Reached its peak, no doubt, in 2021, where you saw, especially in tech, these very high strung auction processes with lots of different bidders and real pressure from sellers to execute very, very quickly. I think that timing will drift a bit. I think things are slowing down a little bit on that front, but you're still in a competitive environment. So if you are a foreign acquirer looking to get into the U.S., you've got to get on this early, and you need to work with someone like Stacey to figure out where there might be issues, because that's going to be a competitive disadvantage compared to a purely domestic, let's say, other bidder. And so I think you want to be thinking about a plan that you can include perhaps as early as even in your bidding package, so that you can start to equalize your proposal to perhaps a purely domestic that may not have some of these CFIUS timing, national security issues. And you're also going to have to think about, how does that play into closing certainty? How am I going to be able to deliver a good, comfortable closing certainty type approach to a target when they may have other options available? And so all of those need to be considered, I think, when you're framing up a bid and you're thinking about, valuation and other terms and all the complexity and interesting things that Stacey talked about. I see every day in terms of just either using that to your advantage and coming up with a plan that makes a lot of sense and scrutinizing that early, even doing reverse diligence on yourself as a buyer, and thinking through where you might run into potential roadblocks or detours that you have to address, and then work that into an overall approach to how you position your bid. I think if you do that, you put yourself in a much better position. You won't necessarily win every one, but I think you put yourself into a much better position than if you sort of sit back in a reactive mode, and then discover that you haven't really thought through how you're going to address things like CFIUS as being a big one. But this would also apply to antitrust considerations or other sort of regulatory processes that may be involved in your deal. So anyway, Stacey, it jumped out at me when you were going through sort of the timing and also the different processes, and how can we make that more competitive if you're a non-U.S. buyer that's coming into the U.S. And by the way, if you've done a CFIUS review before, I've seen that as a very nice advantage, because you've sort of gone through that process. You have the internal controls and reporting processes in place, and also the government is familiar with you, so you have some advantage. If you're doing this for the first time, you really need to kind of front end load that, as you might antitrust or other areas. Otherwise, you're going to be behind. And in today's environment, even though cooling off a bit, you may find yourself just not getting the deals that you want to get. Thanks, Stacey.
Yeah, no, it's a good point. And let me just add to that in terms of other things that you might think about in terms of front loading is the CFIUS process. Again, even though it's confidential, it can become political, right? It may leak out. Sometimes even your target company doesn't want to be acquired by you. Let's be honest, right? Things happen. And there can be, in the right circumstance, an advocacy component here to try and socialize members of Congress that you are your purchase is not going to undermine U.S. national security, that you are a trusted company, you have a track record in the United States. So there's there may be, it's always, situationally specific. There may be sort of a get out in front of the potential sort of negative politics or even sort of competitors who want to sink the deal because they want the deal, right? So there's a lot that goes on a little bit kind of behind the scenes in Washington, where there are some that may want to kill the deal, not necessarily based on the merits, but for politics or for competition reasons. So it can be interesting. It's also something to think about. Doesn't happen in every transaction, but I've seen it, and it can play to your favor if you're aware of it and you take that into account as part of your planning. Okay, let me talk about these other sort of trade related issues, and this goes to kind of due diligence, because you could end up with some sort of unintended long-term liabilities when it comes to customs related issues in particular, that something you need to think about. And this is in terms of your target company, right? So there are various trade actions that impact imports. Now, if your target company can either be, if it's an importer of record, if they're importing goods, that's an issue. It could also be if the target company has negotiated a deal, with their supplier for particular products. And even if they're not the importer of record, as part of that sort of supplier, contract, they have already agreed to how they would account for these future duty liabilities related to these trade actions. And I'm aware of this because sometimes I help companies negotiate these deals when you have these unknowable future duty liabilities. So let me explain what that is. We have trade cases, particularly anti-dumping and countervailing duty proceedings that involve unfair trade actions. They're very popular in the United States. The U.S. industry asks Commerce to look at imports of a particular product from particular countries because they're being economically harmed by either unfairly priced imports or subsidized imports. So, these cases proceed. If they are affirmative, then those products, when they enter the United States, are subject to estimated duties at the time they enter. The key thing here is that the final duty liability for those entered goods may not be known for 2 or more years. I won't go into that. I won't bore you with the details, but so you may, either your target company is the importer of record and they pay a 10% duty on the import of widgets from whatever country, or they have some sort of deal contract with their supplier to sort of split duty liability. But the fact is, if the entries come in, you've paid a 10% duty, those are estimated duties. 2 years down the road, that 10% duty might turn out to be 100%, right? And the importer of record, or maybe your contract terms require you to pay that additional duty plus interest to CBP, to Customs and Border Protection. So something to to consider. The other issue that's currently in the United States is we have a relatively new law that is resulting in the detention of imports related to that may be are made with forced labor, or inputs in those imported goods are made with forced labor. So this is the Uyghur Forced Labor Prevention Act. CBP, by the way, also has its own authority to impose these detentions under another area of law. So the issue here is that there are potential liabilities if your target company is importing goods that may themselves be from China or have inputs from China, and in particular from the Xinjiang region. Customs may detain those imports. There are costs associated with warehousing, and there's certainly costs with the importer demonstrating that those imported goods are not made with forced labor. Right now, customs is very much focused on the solar industry. So solar modules, they've detained thousands of shipments of solar modules at this point in time because of concern about the polysilicon. But it is not limited to solar. It is anything that, raises where customs has a concern about forced labor. The other issues, again, and this is focused on due diligence on your target company, are export control and sanctions. So, export controls, if your company is selling overseas and maybe has goods that could be considered dual use. So the goods or technology has both a civilian and possible potential military use. Commerce regulates that. There's a licensing process. The State Department regulates the manufacture, sale, and distribution of defense-related items. There are new restrictions put out by Commerce on exports related to advanced computing, integrated circuits, semiconductor manufacturing equipment, supercomputers. In terms of these export control restrictions, Commerce maintains what's called the entity list, which is searchable. You can find it online. It contains a list of the foreign persons, so whether those are businesses or government or private organizations or individuals that are subject to very specific license requirements with respect to export, re-export, or transfer of certain items. And the grounds for inclusion on this entity list have expanded over time. So they incorporate sort of export controls that are run out of Commerce, but also the State Department concerns related to national security and foreign policy interests. The other sort of set related to export, but also import and import as well, are sanctions, right? So Treasury, the Office of Foreign Asset Control, OFAC, administers and enforces sanctions. So those sanctions are economic, trade sanctions based on U.S. foreign policy and national security goals. They typically are targeted against foreign, which you may, more likely foreign countries or regimes, political regimes. Obviously, Russia recently being a target of U.S. sanctions, but also terrorist organizations, narcotics traffickers, others that are engaged in actions related to the proliferation of weapons of mass destruction. So again, there is a list that you can access through the Treasury website, the OFAC sanctions list, and use that to search for persons or assets that are blocked or prohibited. And again, this is sort of looking at your potential target company, right? Once you know more about their business, do any of their customers, right, fall into these categories? Because that's a concern, right? Are they not following licensing requirements? Are they working with sanctioned regimes in other countries? And so it's part of your outward sort of due diligence on your targeted acquisition. So that's it for me, David. Thank you.
Thanks, Stacey. Well, that gives us a lot to think about, and now I know why I need to call you every deal, because there's so much to think about. I would say again, it comes down to a lot of these things where the market is from the sell side. Most deals in the U.S. Are moving to almost exclusively rep and warranty insurance with very little seller provided indemnification post closing. Of course, you'll still find deals where you're able to squeeze through some seller indemnification, particularly for known items or other things that might be excluded from an RWI policy. But this is another area where you really want to think about how do those interrelate Are we going to be able to get representations and rep and warranty insurance coverage for things like these import-export compliance failures that may pop up, or custom duties that may come up a year, 2 years, 3 years down the road? Or are there exclusions in some of those policies where you might have a gap, and you may find that you have significant liabilities with a target company, but no one is left to provide coverage for those? So the diligence up front is really critical, and it has to be done quickly, again, to meet sort of the timing demands that you'll face. But also you have to think about, well, where do I have a remedy? And there's structuring and other options to think about, but much of that is kind of in the current market with the seller dynamic and others. So we can talk about that at a later time. So now I'd like to turn to, I think, what the other big item that at least I think about in inbound deals is, what's the foreign person thinking about in terms of the tax considerations, and what's sort of the post-transaction structure going to look like, and is it efficient, and how do we think about setting that up, and what are sort of the key items that a non-US acquirer wants to be thinking about when deciding whether or not to do a US deal with a US target. So Mitch, I'll turn that over to you to give us a little primer on some of the key tax considerations to think about.
I appreciate it, David. Well, good afternoon, everyone. It's really great to be here. And I really appreciate David inviting me to this LinkedIn live show series. I had no idea this was even possible on LinkedIn until I got the invite. I think it's a super cool concept. And again, I really appreciate being invited and participating. So I'm gonna just touch on some high level tax considerations involved in inbound M&A transactions. And by inbound, what I mean is just simply a foreign corporation acquiring a U.S. target. And so that U.S. target can be classified as a corporation or a partnership for U.S. tax purposes. As we all probably know, the U.S. Tax system has real flexible regime for classifying entities for tax purposes. So depending on how the target is classified as a corporation or a partnership, will obviously affect the tax consequences considerably. So I'm just going to focus on the corporate side of the house and just sort of leave the partnerships to the side. And if we could just pull up the first slide here, I think it'd be easier to kind of conceptualize this. So here we have just a simple sort of simplified inbound corporate acquisition. We have on the right hand side we have a foreign acquirer or a foreign corporation that has various foreign and U.S. subsidiaries that it owns, and it's going to be acquiring a U.S. target, U.S. corporation, which in turn wholly owns some foreign subsidiaries. And then if we could just go to the next slide here. So the next slide, this is the post-acquisition structure. So after this deal closes, and the most fundamental problem that just sort of jumps out at you here is that without any sort of tax planning, what we've created now is what's commonly referred to as a sandwich structure. Where we have foreign corporation owns a U.S. subsidiary now, and that U.S. subsidiary in turn owns foreign subsidiaries. And so the U.S. entity is sandwiched between two foreign entities, at least, both at the shareholder level and at the foreign subsidiary level. It's no secret that this type of sandwich structure, is highly inefficient from a global tax perspective for a number of reasons. Probably the most important of which, concerns the repatriation of the foreign profits from the underlying foreign subs up to the U.S. target, and then from the U.S. target to the foreign acquirer. So, just to emphasize the point, assume there's some earnings that are being generated at the foreign subsidiary level here. Depending on the foreign jurisdictions involved, there's most likely going to be corporate income tax imposed on that layer of earnings at the foreign subsidiary level. And then when those earnings are distributed up to the U.S. target, again, depending on the foreign jurisdictions involved, there could be a second layer of tax. Withholding tax charges could be imposed on those earnings when they are distributed up to the U.S. target. From the U.S. standpoint, whether or not the earnings of the foreign subsidiaries are actually distributed to the U.S. target is is not a particularly important inquiry in this fact pattern. And the reason for that is because the United States has enacted some very broad anti-deferral regimes, and so in this particular case, we're dealing with a subpart F income and guilty anti-deferral regimes. And what that does is essentially the vast bulk of the earnings that are generated by the foreign subsidiaries is going to be taxed at the U.S. target level without regard to whether those earnings are actually distributed. And so once they are distributed and then distributed again up the chain to the foreign parent, unless a tax treaty comes into play here, the dividends from the U.S. target up to the foreign acquirer is going to then attract another layer of tax, a 30% withholding tax. And so, as you can see, this is highly inefficient sort of structure from a repatriation standpoint. But that's not all. That's not all the problems with this. We also have a number of other issues here. So this structure is also operationally inefficient. In that it could prevent the overall post-acquisition group from integrating same country operations. It could prevent the group from eliminating or get in the way of inhibiting eliminating redundant functions within the overall post-acquisition group. Could prevent the group from accessing foreign country tax consolidation regimes, and then also it could prevent the group from capitalizing on synergies that would otherwise be available once these two groups are combined. And so, given all of these inefficiencies with the sandwich structure, it obviously makes all the sense in the world, I would think, to have a good game plan coming into the deal. How you're going to actually deal with these tax inefficiencies after the acquisition, or hopefully actually mitigate them as part of the acquisition process. And so, the best approach to mitigating these tax inefficiencies is probably only feasible if the U.S. seller is incentivized to actually work with the foreign acquirer as part of the structuring of the inbound deal to eliminate this sandwich structure as part of the deal itself. And so if the seller is incentivized to do so, what the parties may want to consider here, for instance, is have the foreign acquirer acquire from the U.S. target the foreign subsidiaries sort of out from under. So you'd have an acquisition of the foreign subs, and then you'd have an acquisition of the U.S. target. So you sort of unpiece the thing as part of the acquisition process. And from the U.S. target standpoint, that may not actually give rise to any sort of U.S. tax liability. It just depends on the tax profile. But for instance, if there's sufficient earnings and profits at the foreign subsidiary levels, the U.S. target may be able to sell, the shares of those foreign subsidiaries, and then in that instance, the gain could be recharacterized as a dividend income, and then that dividend income could be sheltered with 100% dividend receipt deduction. So, depending on the profile, there may be ways of just sort of unwinding this process in an efficient manner for both the seller and the purchaser. If that's so, another benefit of that is the foreign acquirer, were the foreign acquirer to acquire the foreign subs, it would then take a fair market value basis in the shares of those foreign subs, and then it could efficiently on-sell those subsidiaries within the appropriate locations within the post-acquisition group. And it could also do that in exchange for debt. And so you can inject debt, within the post-acquisition group, more efficiently if you were to, buy out from under the foreign subsidiaries as part of the acquisition. If this planning opportunity is not available, there's other things you can do, perhaps not as, it wouldn't give rise to as much benefits, but, one thing to think about here is just, at least from a repatriation standpoint, you may want to inject, shareholder loans into the U.S. target, obviously subject to, various restrictions and limitations. The interest deductions will shelter some of the taxable income of the U.S. group, but also from a repatriation standpoint, this will create an efficient repatriation valve. so that, certainly when the principal balance of the note is paid down, you can repatriate those funds without incurring any withholding tax to the foreign acquirer. And then also, depending on, if a domestic tax exemption, a portfolio interest exemption applies, interest on those shareholder loans may be tax-free. It may not be eligible. It may not be subject to the 30% withholding tax, or you could perhaps, eliminate the U.S. withholding tax on the interest component of those shareholder loans, through accessing the U.S. tax treaty network. And so now this begs the question of, okay, how can we, access the U.S. tax treaty network here? Let's just assume that the foreign acquirer here is a Cayman Islands corporation. And so the United States doesn't have a tax treaty with the Cayman Islands. And, but that alone doesn't necessarily mean that you're not going to be able to plan into treaty benefits here. Because most of our tax treaties, that the United States is a party to, they have what's referred to as just an imputation concept, so that, you could have an entity that has no real substance, but is a tax resident in a particular jurisdiction, and still access the treaty benefits by looking elsewhere in the overall organizational chart. And you can impute, for instance, active business operations of, for instance, a foreign subsidiary here. You can impute those activities to the foreign acquirer, and thereby have the foreign acquirer, access the U.S. tax treaty network that way. So just to put it more concretely, if you assume the foreign acquirer here was a Cayman Islands corp, and let's say one of the foreign subsidiaries of the U.S. target was in the U.K., had an active business, operations in the U.K. What you could do is you could interpose underneath the foreign acquirer, underneath the Cayman entity. You could interpose a UK acquirer that now is going to acquire the U.S. target. And even if that UK entity has no real substance, no real active business operations, but yet is a resident of the UK, you could then look to the active business operations of the underlying foreign subsidiary that the U.S. target owns. And as a result of that, you can access the U.S. tax treaty network with respect to payments, between the U.S. target and the foreign acquirer. And so that would be a way of getting down to perhaps a 5%, with U.S. withholding tax costs on dividends that are paid from the U.S. target to the foreign acquirer. And then with the UK, UK doesn't have a withholding tax, under their domestic law for dividends. So the dividends from the UK entity could then be distributed up to the Cayman entity tax-free, without incurring any additional tax costs. So just with that, one planning sort of basic planning point, you could reduce the withholding tax charge here from 30% down to 5% or even 0, for instance, if the foreign acquirer was traded on a public exchange. So those are some of the issues that are associated with the inefficiencies involved in the sandwich structure that results from an inbound acquisition. There's other issues as well with the sandwich structure. One of which is when there's a change in control. So if there's more than a 50% change in control of ultimate ownership over a 3-year period, the acquirer may be limited on the amount of the net operating losses that it could inherit from the U.S. target. So that's something to watch out for. And then there's also probably the most counterintuitive tax trap of them all when it comes to inbound M&A deals is avoiding the anti-inversion rules of the code. And we'll just flip to the next slide here. So by an inversion, what I mean is just simply a foreign corporation. I'm sorry, a U.S. multinational, U.S. parent and multinational just becomes a subsidiary of a foreign corporation. That's all I mean by an inversion. Okay, and so when you have that fact pattern, as you always usually do in an inbound M&A deal, you have to be mindful of these anti-inversion requirements. There's three requirements, but really the one that really comes into play, because the other two are usually met, is the ownership percentage. And what that looks to is what percentage of the post-acquisition group does the shareholders of the U.S. target own after the acquisition? Okay, if it's more than 60%, so if the shareholders of the U.S. target after the acquisition own more than 60% of the foreign acquirer, then there are a parade of horribles that will kick in, and lots of tax adverse tax consequences will follow. So just to give you a few of them, they're just sprinkled throughout the code these days. But you're going to, for a 10-year period, it's going to be very difficult to do internal restructurings. You're not going to be able to use your net operating losses. Foreign tax credits are going to be limited. There could be a 20% excise tax imposed on certain executive compensation packages. Dividends that are paid by the foreign acquirer will no longer be eligible for the capital gain, preferential capital gain dividend rate of 20%. And the list sort of goes on and on. The problem, though, that it's not even, it gets even worse. Okay, so if that 60% ownership interest is 80%, so if the former shareholders of the U.S. target own 80% or more of the foreign acquirer after the acquisition, then the foreign acquirer is treated as a domestic corporation, a U.S. corporation for all tax purposes. And this is the nuclear bomb of an inbound M&A deal when it comes to tax risk. And the reason for that is because it's going to sweep in the entire worldwide operations into the anti-deferral regime of the U.S. And so all of the earnings of the foreign subsidiaries of the foreign acquirer will now be subject to U.S. tax on a current basis, regardless of whether it's distributed. So you may ask yourself, okay, great, 60%, 80%. I get it. It's a big thing to look out for, but I should be able to just look at the ownership cap tables afterwards and know if I'm going to be steering clear of these draconian rules. If only it were that simple, and unfortunately it's not. So if we could just flip into the last slide here. And the reason why it's not that straightforward is because, over the last, I'd say, 10 years or so, there's been several sets of heavy-handed regulations that have been issued that manipulate the ownership percentage. So what you may view as a very small ownership percentage that the former shareholders of the U.S. target have in the foreign acquirer after the acquisition may be much, much greater percentage once you work through all of these detailed sort of manipulations of the ownership percentage that's set forth in these treasury regulations. And so just to give you sort of to emphasize the point on how this could in fact result in a counterintuitive inversion risk, we have just a simple sort of fact pattern here. Let's just assume, we have a U.S. parent and it owns a U.S. sub and it has other foreign and U.S. subs. And in year one, the U.S. parent just distributes the U.S. sub out up to the public, just distributes it to the shareholders in in year one. And then in year two, the U.S. parent is acquired by a foreign acquirer. And the former shareholders of the U.S. parent take back 5% of the stock of the foreign acquirer. And then new institutional investors come in and they take back 95% of the foreign acquirer stock in exchange for cash. And let's assume that cash is then used to pay down debt of the foreign acquirer, or it acquires other assets or investments. The way the rules work in these regulations is that it's constantly manipulating this ownership percentage to artificially inflate it. And so in this fact pattern, you may say, well, I only have 5% ownership of the legacy shareholders of the U.S. target. They only have 5% after. But the way the regs would work here is the value of the U.S. subsidiary that was distributed in year one is going to be treated as that amount of value of stock was issued by the foreign acquirer to the rollover shareholders. So whatever the value is, now their ownership percentage is just increased by that value through a fictional issuance, essentially, of stock to the rollover shareholders. And then it gets even worse from there. In this fact pattern, since the cash proceeds that came into the foreign acquirer from the institutional investors, increased the size of the foreign acquirer because it paid down the debt or it acquired, new assets or new investments. The regs, another area of the regs would ignore the owners, the issuance of the stock to the institutional investors. And so at the end of the day, when the smoke clears here, you could very well, even though there's actually only a 5% ownership interest, this could give rise to an inversion, a 60% or even an 80% inversion. And so that's certainly something to watch out for. So, just to bottom line all of this, I think it's safe to say that, it's always a good idea to bring in your tax advisors as early as possible, in the M&A deal. I think as someone once said, a good defense is oftentimes a good offense. And so I'll just leave you with that one little bit of advice, and turn it back to David.
Thanks much. Appreciate that. I think for me as sort of the corporate deal lawyer, I think, again, my thoughts keep going back to how do we equalize that with, a competitive purely domestic acquirer. And it is part of this sort of front end loading planning process. And I think whenever you have these cross-border deals, it just adds that extra layer of complexity, all of which is almost always solvable and usually in a perfectly reasonable, acceptable way. But it adds additional time, expense. What you don't want to do is make those issues the seller's issues, in effect, of, again, discounting your bid, your proposal, your objectives for the transaction to perhaps other bidders that may have a simpler structure, may have, an easier ability to conform themselves to whatever the best structuring approach is from the sell side. So I just think, at least my approach in these deals is to try to get in front of these issues as quickly as you can, so that you can solve as many problems as you can, or at least put in place a package that you can then, with the bankers, with the financial team, with the deal leads that are running the transaction, in effect, sell to the target and make sure that your bid is as competitive as it can be, knowing that there are some wrinkles, in this kind of an approach that you may not have if it's purely a U.S. domestic buyer, buying a purely U.S. Target. So anyway, we've covered a lot of ground today. I appreciate everyone. If there's any last minute questions, you can type them in, of course, or anything you want to cover. I just want to say thanks to Stacy and Mitch for agreeing to do this. I don't know that they knew exactly what it meant when I said, can you jump on to a LinkedIn Live event with me? This is only my second one, and as people have mentioned, not a lot of I would say larger law firm lawyers are doing this. I hope that if you're watching live, or you watch tomorrow or later over the course of the week, when you can sort of see it on replay, let me know, Mitch, Stacy. I'm sure we'd love to hear if you want sort of more of these. I'd like to do some additional cross-border ones, maybe focused on different aspects of cross-border deals or even outbound deals. But I appreciate everybody following my LinkedIn series, following these. I know, at least on the U.S. side, it's Thanksgiving week. So if you are watching live, I really appreciate that. I know people are, getting ready to head out and travel. So I know all of us, Mitch and Stacy, wish everybody a great Thanksgiving who's in the U.S. And for those of you not celebrating Thanksgiving, still appreciate you following my LinkedIn posts, following LinkedIn Live, and wish you a great week and a great heading into the weekend. Message us if you have any other topics you'd like us to talk about. But thanks very much for attending. Thanks, Mitch. Thanks, Stacy. And of course, thanks, Natasha, for setting up the stream and helping us navigate all the technical complexity of this LinkedIn Live. Thanks, everyone.
All right. Thanks.
Thank you. Thanks.